USDA releases forecasts for 2014 acreage, but in this case the estimates aren't better later than never. Soybean prices swing back and forth, but corn trades flat. Cold winter weather affects just about everything from fuel to fertilizer. Hi, I'm Bryce Norris, Senior Editor of Farm Futures Magazine. Welcome to The Buzz for Friday, February 14th, 2014. Most years the market is starved for news in February, so traders look for scraps of fresh data wherever they can find them for clues about acreage farmers plan for the coming spring. One place farmers look are the so-called baseline tables published by USDA annually as a part of its budgeting process. These are projections made the previous fall used to forecast farm program spending. To do that, USDA must make assumptions about supply and demand, so the tables, and there are dozens of them, make projections about acreage, production, demand, and prices. There's just one problem with the data. The tables are out of date, hopelessly out of date when it comes to the fast-moving futures market. They incorporate supply and demand information about 2013 production and ending stocks from the government's November crop report. Back then, the corn crop looked bigger, and so did carryout. Since then, USDA trimmed not only production, but increased demand as well, most recently in Monday's February crop report. As a result, for corn, the tables show 2013 carryout at 1.887 million bushels, 400 million more than current projections. But the agency's acreage estimates are also a bit iffy. The baseline uses planted acreage of 93.5 million for corn and 78 million for soybeans. Those aren't far from the numbers we found in our first survey of planting intentions that we released way back in August at the Farm Progress Show. Since then, soybean prices gained on corn. By December, that ratio had peaked. We found 82.3 million acres of soybeans and just 92.2 million acres of corn. Moreover, USDA used a yield of 165.6 bushels per acre nationwide for 2014, resulting in a 4.26 billion bushel crop that would propel carryout all the way to 2.6 billion bushels. While it's easy to dismiss the USDA baseline, it does contain a kernel of truth. Carryout is likely to build in the coming years, sending prices lower. So while I've had the most bullish forecasts in the market the past few months, my bottom line hasn't changed. Continue selling 2013 inventory and make sure to have at least 25 to 35% of 2014 corn priced too. Get ready to buy revenue protection crop insurance with 85% coverage of trend-adjusted yield. The new Agriculture Risk Program feature of the Farm Program, coupled with RP and sales, should go a long way towards guaranteeing at least a decent profit for 2014. If the baseline for corn was bearish, the projections for soybeans were anything but. Sure, USDA put old crop carryout at 170 million bushels, 20 million higher than current forecasts, and the estimates for 2014 topped 200 million bushels. But traders focused on the lowball acreage number, ignoring the 45.2 bushel per acre yield USDA used that's easy to dismiss out of hand. The baseline report helped soybeans continue their wild ride for the week. Beans reversed lower Monday when USDA made no changes to carryout in its monthly crop report. Then prices reversed higher on Tuesday before reversing lower again on Wednesday after USDA confirmed that China had canceled 10 million bushels of previous purchases. Prices were already moving higher, however, Thursday, despite a poor week of export sales report, when the baseline data from USDA cemented a move to 22-week highs. The market made more new highs on Friday before finally reversing lower for the week, in what was certainly a tumultuous week. Now that move over 1340 had started to open the door towards the Labor Day highs at just under 1378, but we finished lower than the 1340 level on Friday, leaving that breakout in doubt. South American weather remains an issue driving the market as well. Heavy rains, maybe too heavy, moved through Argentina over the past couple weeks, but were slow to reach southern Brazil. Estimates of production are dropping a little, but so far remain large. Those old crop rallies are fun, but the real work remains new crop. I continue to recommend getting early price protection on a third of 2014 crop by April, because it doesn't look like the farm program provides as much guarantee for soybeans as corn. The rally in November futures couldn't come at a better time, boosting the revenue protection base price a little. A warm-up in temperatures finally appears set, and it couldn't come a minute too soon. In addition to closing the government in Washington on Thursday, the unusual weather affected everything from fuel to fertilizer shipments. Weather may have been the biggest factor in wheat. Bad weather closed Black Sea ports and also kept Canadian shippers from moving their huge crop to the Pacific for export. Some of that Canadian wheat crossed into the U.S., depressing spring wheat prices, but the U.S. did get a little more business into the Middle East. Indeed, low prices stimulated demand, just as the fate of the 2014 crop appeared threatened by winter kill. That could move production substantially below the level forecast by USDA's baseline at 2.22 billion, tightening projected ending stocks. Rallies over the next 2 months or so could provide additional pricing opportunities for new crop wheat. Winter wheat futures are still 50 to 65 cents below revenue protection guarantees from last fall, but the market is looking stronger as it tries to confirm a long-term bottom. Well, that's all for this week. USDA updates its 2014 forecast at the Outlook Conference in Washington, February 20th through 21st. I'll be back then with another look at the markets on the next edition of The Buzz.